Hey everyone, my name is Gloria S, Crump, and I'm the Queen of Real Estate, and I own the Coastal Leaders Realty Group. And I'm here today with Tanner Gorum of First Trust Home Loans.
Hey y'all.
And she is going to go over with us the mortgage myths, so that way she can clear up the air with any questions and just things that we hear that aren't technically true, and just make the mortgage process even easier. So I'll let you take off.
Yeah, so we're just gonna, like she said, talk about some mortgage myths and things that we as lenders hear and see a lot of. One of the number one things that we see is that people think you have to have 20% down to purchase a home, and that is not true. There are several loan options out there, one of them being a conventional loan. If you're a first-time home buyer, then you have the option to put 3% down. And you're actually considered a first-time home buyer if you have not owned a primary residence within 3 years.
And that's actually really good, because a lot of people think first-time home buyers is strictly they've never purchased. So
Right.
as long as they haven't owned a home in 3 years, they will still qualify.
That's correct. Yep.
Okay.
Yep.
And then if it's been within the 3 years, they can put how much down for a conventional?
5%.
Okay, so
Yep.
that's good to know.
Yep. So you can do a 5% down if you have owned a house in the past 3 years. A primary residence, not just a property, a primary residence within 3 years.
Okay.
And then you've also got your FHA loans where you're able to put 3.5% down, and that's for all buyers. You do not have to be a first-time home buyer to utilize that program. And then, of course, you've got your USDA loans. So if you're in a USDA-approved area, which usually is going to be the kind of outskirts of town, that type of thing, an agricultural area, you're able to do a 0% down loan, and then the same with VA loans. So if you are a veteran or a surviving spouse to a veteran, then you are eligible for a VA loan.
And surprisingly, Gulf Shores and Orange Beach, those do qualify for the USDA.
Yes,
too,
there are some USDA approved areas in Gulf Shores and Orange Beach. So. And then you also have the option to do what we call an Alabama bond loan, and that's called a down payment assistance program. And that's something that you could talk with your lender about as well, about doing something like that. And then, so the myth around 20% down comes from the fact that if you don't put 20% down, then you have to pay monthly mortgage insurance. But, you know, it kind of offsets itself. If you do the 3% down, your monthly mortgage insurance really isn't that much. And there's just been some adjustments for mortgage insurance as well, where they've actually lowered the price of how much that's going to cost you monthly.
That's actually really good, because that'll obviously go into effect with your debt to income ratio.
Correct. Yes.
And it helps obviously with the insurance going, increasing now. So
And
with
insurance has increased some on the Gulf Coast due to
Sally
in 2020.
Yes. So that's really good to know that
helps.
the mortgage insurance has gone down.
So, and then another thing we want to talk about is that a pre-qualification is the same as a pre-approval. That is not true.
No.
So I'm sure you've come across some scenarios.
Yes, I have.
Where,
Several.
Yeah. So a pre-qualification relies solely on self-reported financial data. This gives a rough estimate of how much home you can afford, and is majority of the time not accurate and doesn't carry much weight when you're trying to make an offer. So that means that you apply for a mortgage online and you put in there how much income you make monthly, how much assets you have, meaning how much money you have in the bank, all of that stuff, and then that lender is taking your word for everything you put in that application and saying, okay, we believe what you said about how much income you're reporting monthly, all of that, and this is how much home that you can afford. Whereas with a pre-approval, when you're using a lender that does a pre-approval, they're actually going to verify your monthly income and how much money you have in the bank. They're going to look at your credit report and
Just has a lot more
verify all of that. So it holds a lot more weight, and you're getting a way more accurate guesstimate on how much home you can actually afford.
And as a listing agent, I always look to see if it's a pre-qual or a pre-approval letter, because especially when we might have multiple offers, that's really going to hold weight.
Right.
An And if it gets very close, obviously my clients are going to be more comfortable with someone who's actually provided the documentation
Right.
to that lender versus just telling them what they.
Well, I mean, time is valuable. Your time is valuable.
For
your
sure.
client's time is valuable. My time is valuable. So when you're out showing property, you want to know that
This
this
person
client
can actually
can buy this house, and I'm not just out showing property and wasting my time doing it.
Yeah,
So,
for sure.
So a pre-approval is always recommended. That way you do have that confidence when you're out looking at property. And if you don't know what lender to use, then you can ask your real estate agent, and they're going to be able to tell you, hey, here's a list of preferred lenders. I know that what kind of work they do. I know that if we're getting a pre-approval from them, then it's pretty accurate. And we're not wasting anybody's time there. But with that said, a pre-approval does not guarantee a closed loan. So there are some things that we have to look out for once we actually get that accepted contract and everything. And that's basically, don't go out and buy a new car or a new boat or
the furniture.
Yeah, the furniture. Don't go open a card at Rooms to Go and buy your furniture before we close, because we're going to do a soft credit check.
It, but you'll really mess it up.
And we're going to do a soft credit check right before we close. And if we see you've opened a new card, we're going to have to factor that into your debt to income ratio.
Yes.
So another one, I see this one a lot with first time home buyers. The younger crowd that's never purchased a home or anything like that. Your down payment covers your closing costs, so that's not accurate. Your down payment goes strictly towards the amount of equity that you initially own in the home. You still have to pay your closing costs, and closing costs, if you don't know, are your appraisal fees, your title fees, insurance premiums, things like that you're going to have to pay on the day of closing.
And escrow too.
Yes, escrow. You're gonna have to
pay.
What,
you go about 3 months?
Yeah, 3 months for taxes and for insurance.
Yes.
So you're gonna have to pay that. Luckily, right now, we are in a market where we're seeing a lot of seller concessions being accepted in offers. So you can actually ask when you're writing your offer for the sellers to pay some towards your closing costs.
And prepaid.
Yes, and prepaids. Yeah. So we are in a market right now where we're seeing a lot of that. So that's definitely helpful.
So take advantage of it.
Yes. Another one is you cannot pay off your loan early. This is not true as far as your conforming loan products go. So conventional, USDA, VA, FHA. There's not typically prepayment penalties on those unless there is an overlay that your lender specifically has.
And
but
usually
you should
it's a
be
time frame.
Correct, and they should make you aware of that before closing and everything.
So because they want to accumulate the interest.
That's right. Yeah.
Gotcha.
So that's how they make their money, is off the interest that you're paying. So, but it is still a good question to ask your lender in the beginning, just so you have that.
Because some investment loans have that.
Yes, and there's some in-house specialty products sometimes that, like you said, investor loans that they will kind of have that clause in there, prepayment penalty clause. So, another one. People think that you need perfect credit to qualify for a mortgage. That is not true. It's great to have perfect credit, but
you
sometimes
get a better interest rate.
Yes, you do get a better interest rate when you have better credit, but
that doesn't mean you can't buy.
That is correct. Yeah, so it does play a major role in your ability to qualify, but that doesn't mean you have to have a 700 plus credit score.
No.
There's loan programs that, with a conventional loan you can go down to 620, and then with your government-backed loans, so VA, USDA, FHA, you can go down to a 580. So that's very helpful.
Yes, it is.
So let's see. Applying for a mortgage will hurt your credit. So I get this a lot when I have clients contact me and they're like, we're not really sure if we can, afford a home right now. We just kind of want to talk to you, but we don't want you to pull our credit. Well, then I would be issuing a pre-qualification, and that's not something I feel comfortable doing. So in order for me to give that pre-approval and know what your credit looks like, then I need to do a credit check. It's not going to hurt your credit, really. I mean,
and how long does it temporarily affect it, even if it is a small hit?
It's going to be a very small hit. I'm talking like 5-10 points. If you're only doing like 1 or 2 credit pulls, like say you're shopping around different lenders and stuff like that, And it's only those credit inquiries only show on your credit report for 120 days.
Okay. All right. Well, I have a question. So let's just say someone is at 620 already, but they get their credit pulled, and then all of a sudden that has, you know, 5 to 10 point credit. Well, now they're under that threshold. Is there any way a bank would look like, say, well, actually you were at the 620, but now you have your credit pulled.
Say it pulled down to 617 or something.
Yeah, 617.
So unless we have a reason to need to repull credit, we're going to pull what was on that initial report.
Gotcha. Okay.
So if there's not some reason, like say they had a collection or a dispute or something on their credit report that they needed to get removed, and then we went back and had to repull credit and it was down to the 617, that can make a difference.
Gotcha.
But unless we have a reason to need to repull, then it shouldn't. And typically in that scenario, if a collection or a dispute comes off your report, it's actually going to raise your score.
Okay. All right. Well, that's good to know.
Having debt or student loans is a deal breaker. So that's not true. Debt's not good, but having those open lines of credit is good because that's how you actually build your credit. So those are good. A good thing to have. You just don't want to have an accumulation of debt. You know where it's going to
and reoccurring.
Right.
So you want to pay it off, but that's when the lender comes in and can kind of tell you, hey, you might not want to pay off this full amount. You need to pay off a certain percentage of it. And then that can actually help sometimes increase the interest.
And we don't look at your overall debt. Like say you owe $10,000 on a credit card. We're actually looking at that minimum monthly payment. That's what we're factoring into the debt to income ratio.
Okay.
So and debt to income ratio, just in case you don't know, is we're taking how much debt you owe monthly, so that minimum payment that you owe, and looking at how much income you're bringing in monthly. And
your gross income.
Yes, your gross income, yes. So that is one thing, Well, we can
we'll get that in a minute.
But yeah, spoiler alert, lenders use your gross income, not your net. So that's good because we're not taking into account the taxes and maybe your insurance, your health insurance or something comes out of your check or anything. We're actually looking at the gross monthly income.
That is good.
So, and so student loans right now, there's been like a lot of back and forth where people think, well, when we pull your credit, it's showing a $0 monthly payment because they've been in deferment through the CARES Act since COVID, basically.
Okay.
So we actually, there's talk that they may be forgiven or whatever, but that's down the road and we don't know what's actually going to happen with that. We're actually still having to count those student loans against you.
That's what I was about to ask.
Yes. So we're, even though the credit report might say 0, we're, depending on your loan program, we're either calculating the total loan amount by 0.5% or 1% of what that loan amount is. So we are still having, the government is still making us use that because we don't know exactly how long they're going to be in deferment for.
Okay.
So,
well, that's good to know because that has been something that's been discussed recently. Yeah. And new clients of mine.
Right. Yeah, and it just depends on what loan program we're using, also, as to how much. We have to count against them. And then another thing that I hear a lot of, I'll see realtors kind of maybe turn their nose up at an FHA loan, or buyers who think that, FHA loans are for the poor, or
it's definitely
the little income people. That's not true. FHA loans have come a really long way. Yeah. And they're actually a great loan option.
I'm starting to see that now. More people are doing FHA.
They're becoming a lot more popular, and the reason for that is because FHA and USDA, your government-backed loans, we're actually seeing better interest rates on those than we are conventional right now.
And that's why I'm starting to see, even, like, for instance, I had a listing, someone is putting $60,000 down, and I was kind of shocked to see the FHA, but then I realized, well, the FHA interest rates are a lot, more competitive than the conventional one.
Right, yeah.
Interest
So
rates.
it's not always the people that are just needing to put that 3.5% down.
Exactly.
There's a lot of factors.
They're wanting to go for the lower interest.
Right, and any good lender is going to be able to look at your scenario and know what loan program that you fit best in.
Exactly. So. And I mean, FHA does have stricter guidelines for, and what are those?
So
a couple of the guidelines.
So there's
If
some
you're
underwriting.
thinking about purchasing and you're
Right.
teetering, the house might not qualify. You might qualify for an FHA.
Right.
The house might not qualify.
Right. Correct. Yeah. So just because you qualify doesn't mean the house does. The appraisal contingencies are a little tighter on an FHA loan. So you're looking at, there can't be any peeling paint in the house.
No
There
peeling
can't be, your windows have to open and close for fire safety reasons and stuff like that.
Rotten wood is a huge deal killer.
Yeah, so anything like that, shrubbery around the house. If the house is grown up
really?
and there's like weeds growing up the side of the house, that has to be removed.
Oh wow!
And it'll,
Not know that.
the appraiser will put that in the appraisal report that a final inspection is needed to show that
My house would not qualify.
So yeah, that's one that I've seen too. But yeah, it is a little stricter, but there's definitely it's definitely a good loan option.
Yeah. Awesome. Well, I hope that y'all learned something, because I definitely did, and I've been doing this for 19 years, so I definitely learned some good information, and I really do appreciate you coming and talking.
Absolutely,
And,
I appreciate you having me.
Yes, and thank you for watching, and if you have any questions, feel free to reach out to us. At the end of the video, we'll have Tanner's contact information. She's a wonderful lender, and we look forward to hearing from you.